They wanted silence. They wanted a quiet holiday season. They wanted Christmas Eve to pass without incident, but the global silver market refused to cooperate. While the Western world was distracted by festivities and the screens in New York were showing a stagnant price of $72, something far more dangerous was happening off-screen. Right now, not yesterday and not last week, physical silver in Shanghai is trading at $78.49. Today, the market moved with a level of violence we rarely see in precious metals. Silver screamed 8.12% higher in a single trading session. Let that number sink in for a moment. That is not a rumor, that is not a projection, and it is certainly not a glitch. That is a real physical price being paid for metal that must be delivered to the buyer. This means the arbitrage gap, the difference between paper prices in the West and physical silver in the East, has exploded beyond all historical norms. The China silver premium has widened to an unimaginable $7 per ounce in some contracts. In the most liquid contracts, we are seeing premiums over $8 per ounce. This is not just a rally, and it is not simple volatility. This is massive system stress. Once a gap like this starts to expand, markets do not close it politely. They close it violently. The 78.49 Shanghai print changes everything. We are witnessing the story of the moment price control failed, and it is happening in real time. To understand why this is a systemic crisis, we must look at the death of the arbitrage mechanism. In a functioning global market, a $6.49 gap should be impossible. Usually, a trader would buy silver in New York for $72, ship it to Shanghai, and sell it for $78. Even after shipping and insurance, they would pocket a risk-free profit of nearly $5 an ounce. Normally, thousands of traders doing this would push New York prices up and Shanghai prices down until the gap disappears. But that is not happening. The bridge between West and East is collapsing because the metal is simply not there. The arbitrage mechanism is broken because Western vaults are being drained at an alarming rate. Look at the data from the Comex registered inventory, which is the silver available for immediate delivery. 3 months ago, it held over 120 million ounces. 2 months ago, that dropped to 95 million. Last month, it was 73 million. This week, we are likely looking at a number below 70 million ounces. That is a 40% decline in available inventory in just 90 days. Traders are trying to move metal east to capture the profit, but the rate of drain is exceeding the rate of replenishment. Mining production is fixed, refining takes weeks, and logistics cannot be bypassed. You cannot teleport silver across the Pacific. While the metal slowly moves, demand in Shanghai accelerates. This creates a vicious loop. Shanghai raises the bid to attract metal, Western vaults drain further, and the gap stretches instead of shrinking. When a commodity gap exceeds 9%, the system does not glide, it snaps. We are no longer looking at theoretical models or paper speculation. We have physical proof of a massive shift in the market. Today, exactly 17.7 metric tons of silver were removed from the Shanghai Futures Exchange vaults in a single session. To put that in perspective, 17.7 metric tons equals approximately 569,000 ounces of silver. Gone. Removed. Taken into private storage or industrial consumption in one day. This is not a normal drawdown or a routine inventory adjustment. This is systematic depletion happening at an accelerating rate. It is happening at the exact moment premiums are exploding to record highs. Why would anyone withdraw such massive amounts while the price is surging 8.12%? The answer is simple. Buyers no longer trust the exchange system. They are taking physical delivery and moving it to private vaults because they are securing supply before the vaults go empty. This is the behavior you see right before a market breaks. It is not gradual drainage, it is panic drainage. If you annualize the current rate of withdrawal from the Shanghai system, you are looking at over 200 million ounces per year. That is more than the entire annual production of Mexico, the world's largest silver producer. The physical reality is overwhelming the paper fiction. At $78.49, a rational speculator might hesitate. But industrial buyers are not speculators. They operate on survival logic. To understand why this gap can expand to $10 or more, we must understand inelastic demand. Imagine you run a solar panel factory with a contract to deliver 10,000 panels next month. That contract is worth $5 million in revenue. Each panel requires silver. If you do not get that silver, you cannot deliver the panels. If you cannot deliver the panels, you lose $5 million, face penalty clauses, and destroy your reputation. At $72 an ounce, your silver cost is one amount. At $78, it is slightly higher. The difference might be $40,000. Now, ask yourself, would you risk a $5 million contract to save $40,000? You pay the higher price every single time. This is why industrial demand is inelastic. The cost of the input is small relative to the value of the final product, but the cost of not having it is catastrophic. This is why factories in Shanghai are bidding against each other. They are not negotiating on price, they are negotiating on delivery. They are asking, can you deliver tomorrow? If the answer is yes, they pay whatever it takes. This survival logic is the engine driving the Shanghai price to $80 and beyond, while the Western paper markets remain disconnected from reality. The timing of this surge could not be more dangerous for the shorts. We are entering the worst possible window for market stability, the Christmas holiday season. Normal trading days have depth, which means there are many participants and market makers providing liquidity to absorb big moves. But holidays are different. Liquidity is thin, risk desks are lightly staffed, and trading volumes drop significantly. In this environment, it takes very little force to move the price. It is like pushing someone in an empty room versus a crowded one. The impact is outsized. Today's 8.12% move in silver is a direct result of this liquidity vacuum. But there is a technical powder keg hidden in the data, the gamma trigger zone. The range between $75 and $80 is loaded with call options. When market makers sold those options, they assumed they had time to hedge. They did not expect a vertical move during a holiday week. As Shanghai pushes toward $80, these market makers are forced to buy silver to hedge their positions. But because there are no sellers in a thin market, they have to bid higher and higher just to fill their orders. This creates a feedback loop where forced buying drives prices higher, which forces more buying. This is how you get $5 moves in a single session. For decades, the world has looked to New York and London to set the price of precious metals. The Western paper markets, dominated by high-frequency trading and futures contracts, were the undisputed kings of price discovery. But today, the $78.49 print in Shanghai suggests that the crown is slipping. We are witnessing a fundamental shift in where the real price of silver is determined. In a surplus market, paper sets the price because metal is abundant. But in a deficit market, physical metal sets the price because you cannot settle an industrial need with a digital contract. Shanghai is where the physical metal is being consumed. It is where the solar factories, the battery plants, and the electronics manufacturers are located. They are no longer willing to wait for a New York paper price that does not reflect the reality of their empty warehouses. When the premium between East and West reaches 11%, the Western price is no longer a reference, it is a discount. And in a global economy, massive discounts on scarce assets do not last. If the West cannot supply enough physical silver to close this gap, the paper market faces a total loss of credibility. The market is choosing the physical reality of the East over the digital promises of the West. When the gap hits $10, it will not be a trading opportunity. It will be the official declaration that the old system of price control has failed. As we move into the next 24 hours, you need a framework to filter the noise. There are 5 specific signals that will tell you whether this gap explodes into a total system break or temporarily contracts. Signal 1 is the Shanghai price at open. Watch if it holds or rises above $78.49. Any consolidation above $78 after an 8.12% surge is incredibly bullish. It tells you the demand is persistent. Signal 2 is the Western spot lag. If New York opens and the price stays at 72 while Shanghai climbs to 80, the gap has widened to $8. This is a clear sign of system breakdown where paper and physical have completely decoupled. Signal 3 is the physical premiums. Check the dealer websites. If the spot price is 72 but the cheapest coins are selling for $88, that is a $16 premium. That confirms the physical market is declaring its independence. Signal 4 is dealer availability. Watch for out-of-stock notices or pre-order only status. If dealers go to call for quote, It means they can no longer find metal to sell. Signal 5 is volatility without volume. If you see the price jump $2 on very few trades, it means the order book is empty. If these 5 signals align, the market is no longer trending, it is resetting. We have reached the moment of truth. You can continue to watch the Western screen and believe that silver is only $72, or you can understand what a $78.49 price in Shanghai actually means. It means the real price has moved on. It means the arbitrage bridge has collapsed because there is not enough metal left in the West to satisfy the hunger of the East. When the gap hits $10, this will not be remembered as a simple rally. It will be remembered as the moment physics took over from finance. If you are holding physical silver, you are positioned on the right side of this transition. Your metal cannot be settled in cash or deleted by a computer. It is the ultimate asset in a market under extreme stress. But for those waiting for a lower price to enter, understand that today's 8.12% move suggests the window is closing. The move from 78 to 80 or 82 could happen in hours, not weeks. The next 72 hours will not be about analysis, they will be about scorekeeping. We will track every tick in Shanghai and every physical withdrawal. This is the end of the fiction. The physical market is taking back control and the reset will be violent. Subscribe and stay tuned as we watch the $10 gap become a reality.